Good morning and welcome to TOI Japan Market Radio for April 7, 2026. I'm your host here in Tokyo, and this show is designed specifically for global investors who are tracking Japan exposure or considering allocating to Japanese markets. Let's dive straight into today's session.
Thanks for having me. So looking at the headline numbers, we saw the Nikkei 225 close at 53,429.559. Up just 0.03%, so essentially flat. TOPIX performed a bit better at 387.8, gaining 0.259%. The Mothers Index added 0.165% to close at 2422.0, while J-Rights edged down 0.104% to 1926.0. On the currency side, dollar-yen is sitting at 159.742. Down a slight 0.024%. In commodities, gold priced in yen fell 0.341% to 17,545.0, while crude oil had a notable move higher, up 2.651% to 115.39. So overall, a fairly muted session for equities with some interesting cross-currents beneath the surface.
That oil move certainly stands out. Before we get into the drivers, I want to start with a headline that's getting attention globally today. ASML shares fell on news that the U.S. Congress is planning to further restrict exports of semiconductor equipment to China. How should Japan investors be thinking about this?
This is a significant development, and it actually has some positive implications for Japan's semiconductor supply chain. What's happening here is that ASML, the Dutch semiconductor equipment giant, is facing additional US-led export controls that would limit its ability to sell advanced chip-making tools to Chinese customers. For Japan, this creates a competitive opportunity. Japanese semiconductor equipment makers like Tokyo Electron, as well as companies like Nikon in the lithography space, could potentially gain market share as global customers look for suppliers that are less subject to US export restrictions.
So this is part of the broader tech decoupling trend we've been tracking.
Exactly. And beyond the equipment side, Japanese chipmakers and advanced materials suppliers could see increased demand as the semiconductor supply chain diversifies geographically away from China. Companies like Renesas and Shin-Etsu Chemical are positioned to benefit from this structural shift. For the Nikkei and TOPIX, the impact is modestly positive, particularly for the semiconductor and materials sectors, though a lot of this theme is already partially priced in given how long the decoupling narrative has been playing out. On the yen, the effect is pretty neutral, maybe a slight safe haven bid from the geopolitical tension, but nothing dramatic. JGB yields shouldn't see much direct impact from this news.
Understood. Staying with the geopolitical theme, there's another headline today. Japanese stocks held only slight gains as geopolitical tensions limited upside. It sounds like the market wanted to do better but couldn't quite get there.
That's a good way to put it. Despite closing in positive territory, the gains were really quite modest, and you could sense investor caution throughout the session. The constraint is coming from renewed geopolitical tensions, which are keeping a lid on risk appetite. For Japan specifically, this matters because Japanese equities are highly sensitive to global risk sentiment. Japan is a major capital exporter with significant overseas earnings exposure, so when investors move to a risk-off posture, Japanese stocks typically underperform. We saw that dynamic playing out today. The market wanted to rally but just couldn't build momentum.
And what about the implications for the yen and yields if these tensions escalate further?
Good question. On the yen side, geopolitical risk usually supports yen demand as a safe haven currency. If tensions intensify, we'd likely see the yen strengthen, which would then create a headwind for exporter earnings, companies that rely on a weaker yen for competitiveness abroad. For JGB yields, risk-off sentiment typically drives flows into government bonds, which would keep yields suppressed. We'd expect downward pressure on 10-year JGB yields if this risk-off environment persists, and that actually supports the BOJ's yield curve control framework. So the setup here is equities facing a cap on upside, yen potentially stronger, and yields under downward pressure.
That makes sense. Now shifting to another key story today, UBS lowered its 2026 target for the S&P 500, citing risks from the Middle East conflict. This is a US equity call, but I assume it has implications for Japan as well.
Absolutely, and those implications are meaningful. When a major bank like UBS lowers its S&P 500 target due to geopolitical risks, it's signaling softer expectations for global growth. For Japan, that's a concern because Japanese exporters, particularly in autos, semiconductors, and machinery, are heavily dependent on global demand, especially from the US. A weaker outlook for US equities typically translates into weaker demand for Japanese exports. But there's another angle here that's even more direct for Japan: energy prices.
Right, because Middle East tensions tend to push up oil and gas prices.
Exactly. Japan is extremely dependent on energy imports, particularly crude oil and liquefied natural gas. If Middle East instability drives energy prices higher, and we're already seeing crude up over 2.6% today, that puts pressure on Japanese corporate margins and adds to inflation concerns. Energy-intensive sectors would be particularly vulnerable. For the Nikkei and TOPIX, this setup suggests downside risk, especially for cyclicals and exporters. Defensive sectors might outperform in this environment. On the yen, we'd likely see safe haven strength, which again would hurt export competitiveness. And JGB yields could decline further if risk-off sentiment accelerates, supporting the long end of the curve.
So essentially, the UBS downgrade is a reminder that Japan's markets don't operate in isolation. Global growth fears and energy price shocks both flow through to Japanese assets.
That's exactly right. And I'd add that this creates a somewhat uncomfortable backdrop for Japanese equities. You've got geopolitical risk capping upside, energy costs potentially squeezing margins, and a stronger yen environment that makes life harder for exporters. It's a confluence of headwinds. That said, if energy markets stabilize or tensions ease, a lot of this pressure could reverse fairly quickly. But for now, caution is warranted.
Let's bring this together for our listeners. We've covered quite a bit of ground today: semiconductor export restrictions, geopolitical tensions weighing on equities, and the UBS downgrade reflecting Middle East risks. What's your main takeaway for global investors watching Japan right now?
The main takeaway is that Japan's market is currently caught between modest domestic support and significant external headwinds. The semiconductor supply chain story offers some structural positives for Japanese tech names, but broader geopolitical uncertainty and energy price risks are constraining the overall equity market. The yen is likely to remain supported as a safe haven, which is a headwind for exporters, and JGB yields should stay under pressure as long as risk-off sentiment persists. For global investors, the key is to monitor how geopolitical developments unfold over the coming sessions. Those will be the primary driver of near-term performance. This isn't an environment for aggressive positioning, but it's also not one where you abandon Japan exposure entirely. Selectivity matters.
Well said. That's a balanced way to frame the current environment. If you're a global investor tracking Japan's markets or considering Japan exposure, we hope today's briefing gave you some clarity on the key drivers. We cover these themes daily, so consider subscribing if you want to stay informed. Thanks for listening to TOI Japan Market Radio, and we'll see you in the next session.
Thanks, and we'll talk soon.